What if the debts we argue about in public aren't the debts that matter? What if the real losses never appear in budgets, elections, or headlines, but are quietly netted, rolled, and reassigned in a place you can't see? Every time a crisis hits, we're told the same story. Deficits ballooned. Central banks provided liquidity. Growth will fix the rest. And yet, year after year, the liabilities rise, the promises multiply, and nobody can answer a simple question: where did the losses go? Tonight, we follow the faint fingerprints of a ledger that doesn't show up in textbooks. A ledger that spans swap lines, clearinghouses, offshore dollars, and intercentral bank IOUs. The ledger where nations balance debts with silence. To read this ledger, you need to know a few names that rarely share a sentence in the nightly news. Bank for International Settlements, BIS. The Central Bank for Central Banks, founded in 1932, quietly settle thorny claims. Bretton Woods and the IMF, a post-war framework that promised stability and created special drawing rights reserve assets conjured for balance, not for groceries. Eurodollar market, dollars created outside U.S. borders, beyond the Fed's direct reach, multiplying through lending and collateral chains. The plumbing, chips, CLS, and Euroclear clearing systems that net trillions daily. And Target 2, the Euro area's internal ledger, where imbalances reveal political strain before politicians do. Swap lines, central bank lifelines that beam dollars across borders when funding freezes without a single parliamentary vote. None of this is cartoon conspiracy. IT's an evolving survival mechanism. A way to avoid admitting default by transforming it into liquidity management. The twist: every workaround demands more complexity and more faith in institutions the public barely knows exist. In the 19th century, the gold standard kept accounts brutal and simple. If you ran a deficit, your gold fled. Pain forced adjustment, local bank clearinghouses netted payments, and the leftovers settled in metal. World War I shattered that logic. Interwar Europe needed to square impossible accounts without triggering revolt. Enter the BIS in 1930. A neutral back room where central banks could net exposures, extend credit discreetly, and kick political explosions down the road. The habit formed: roll the claims, net the losses, speak softly. After World War II, Bretton Woods crowned the US dollar convertible to gold at $35 an ounce. Central banks held dollars. The US promised gold. Stability, at least on paper, but a second system grew in the shadows. In the 1950s and 1960s, the Eurodollar market, offshore dollars in London and beyond, let banks create dollar credit outside US regulation. By the late 1960s, more dollars lived offshore than at home. In 1971, convertibility died. The dollar was no longer a gold claim. It was a promise secured by US treasuries, global oil priced in dollars, and faith. Derivatives exploded in the 1980s and 1990s. Letting institutions hedge, transform, and net exposures at scale. Collateral chains lengthened, and the silent ledger matured. Public debts rose, while private balance sheets quietly warehoused the risk. Stress reveals plumbing. When the system creaked, the hidden ledger blinked into view. Latin American debt. 1980s, US and European banks were drowning in sovereign loans. Outright default would have detonated balance sheets. The solution was Brady bonds in 1989. Securitize, extend, collateralize with treasuries. Losses smeared across time. LTCM 1998. The hedge fund's positions threatened the derivatives web. The New York Fed convened a private rescue. No vote, no drama, just balance sheet surgery behind closed doors. Global financial crisis, 2008. Subprime mortgages were kindling. The fire was dollar funding and collateral. Repo markets froze. The Fed stepped in as global dollar backstop and extended swap lines to foreign central banks. Offshore dollar liabilities met their maker: the Fed's balance sheet. Eurozone crisis, 2011-2012, a currency without a treasury. Capital fled south to north. Target 2 imbalances soared past €1 trillion. Germany's Bundesbank became the quiet creditor to the periphery. The euro held together because an internal ledger said it would. Repo shock 2019, overnight rates spiked. The plumbing clogged. The Fed re-entered repo and added standing facilities. Not a fiscal battle, an operational patch. Pandemic 2020, the demand for dollars went vertical. The Fed reopened massive swap lines, launched facilities to lend against treasuries, and bought assets at record speed. The IMF injected $650 billion in SDR's reserves via keystroke. The world was refinanced quietly. UK gilt crisis, 2022. A pension derivative spiral forced the Bank of England to buy long gilts to restore market functioning. Translation: net the losses now, argue policy later. The aftermath wasn't a headline, it was an architecture. Central bank balance sheets ballooned, suppressing yields and masking risk premia. The Fed now carries a deferred asset, operating with negative remittances to the Treasury losses parked in accounting amber. The Bank of England received a Treasury indemnity. Taxpayers quietly backstopped QE losses. The ECB kept the euro intact while Target 2 imbalances persisted, political tension expressed as accounting claims. The Bank of Japan acquired such a share of JGBs that the yield curve became a policy choice, not a market outcome. Negative yielding sovereign debt peaked around $18 trillion in the late 2010s, savers paying governments to hold paper. That only makes sense if the system promises stability, no matter the arithmetic. We tightened regulations. Basel III raised capital and liquidity standards. Derivatives moved towards central clearing, banks drafted living wills. But the core dependency remained, a world that requires ever-expanding high-quality collateral and dollar funding, deployed by an offshore network with public backstops in Washington, Frankfurt, London, Tokyo, and Basel. Risk migrated to non-banks, money funds, hedge funds, dealers, and pension liability hedges. Rehypothecation chains shortened in stress, amplifying collateral demand, forcing central banks to lend securities, buy assets, or guarantee markets. Governments shifted obligations off balance sheet, unfunded pensions, guarantees, public-private deals, and local financing vehicles. Different names, same function. Liabilities stored in the wings. Here's where the silence speaks in numbers. Global debt, public and private, now exceeds $300 trillion, according to multiple international trackers. The notional amount of outstanding derivatives sits above $600 trillion per BIS data, much of it used to net and transform exposures so surface calm persists. U.S. net interest outlays are on an annualized pace near or above $1 trillion as rates reset higher across a massive debt stock, no vote required. The hidden ledger simply applies a new price to old promises. Target 2 imbalances remain over €1 trillion, an internal barometer of euro area stress and cohesion. The 2021 SDR allocation of $650 billion boosted global reserves without a single taxpayer writing a check. Offshore wealth parked in low-tax jurisdictions measures in the A trillions capital that can stabilize or shock funding conditions based on signals from the plumbing, repo rates, cross-currency basis, and treasury liquidity. In 2019, 2020, and 2022, the pattern rhymed. Something in the pipes jammed. Official balance sheets absorbed the pressure. Public debate arrived late. Causality repeats. Leverage builds in quiet times. A funding shock exposes collateral fragility. Central banks transform credit risk into time. And political systems accept the bargain silence now. Consequences later. Watch the plumbing, not just the speeches. Repo rates, swap line usage, cross-currency basis, and Target 2 flows reveal stress before press conferences do. Who's the creditor? It's often the system itself, through pensions, insurers, banks, and central banks. Losses are socialized via inflation, negative real yields, deferred accounting, and internal netting. Complexity is a policy instrument. Every new facility, guarantee, and clearing rule deepens path dependence. Expect rolling fixes, not resets until politics or trust forces a rewrite. The hidden ledger can postpone arithmetic, but it cannot repeal trust. Fragmented geopolitics, competing payment rails, or a sudden refusal by savers to fund governments at today's prices could overwhelm the netting machine. If silence is the stabilizer, what happens when citizens, or even central banks, stop accepting quiet settlements? Watch where silence grows loudest. That's where truth is being balanced. If this helped you see the machinery behind the headlines, subscribe for more deep dives into money history, global debt, and the paradoxes hiding in plain sight. Drop a comment with the signal you track repo basis, swap lines, or Target 2 and share this with someone who still thinks debt is just a number on a screen. The ledger is real. Learn to read it.